gold and silver continue to crash.
Both metals have crashed.
Bloodbath in precious metals.
Gold crashed 26% in 3 days last week. Silver fell 35%. Indian gold ETFs lost 16% in a single session. And yet, JP Morgan came out and said gold will hit $6,300 per ounce by the end of this year. That's another 30% upside from the current levels. What makes this even stranger is that India just signed a massive free trade deal with Europe. Trump says he'd slash tariffs on Indian goods from 50% to 18%. Normally, when good news hits, gold falls. Investors move money out of their safe havens into riskier assets. But gold didn't fall. It actually crashed and then bounced right back up, almost like the rally never broke. So, what's exactly happening here? Hello folks, I'm Shashank, you're tuned into FinShots TV. We're part of 01 Media by Zerodha. Before we break down this wild gold rally, here's a quick word from Akanksha.
Hi folks, I'm Akanksha and I had a small message for you. Thank you so much for tuning in every week and watching all the content that we put out here from FinShots TV. It has truly been a pleasure researching, writing and presenting all these stories to you. I wanted to say that I would be moving on from FinShots TV. I hope that you keep watching. See you on the other side.
Alright, quick context folks. 2025 was a record year for gold. It hit all-time highs 53 times in a single year. Total global demand crossed 5,000 tons for the first time ever. Central banks alone bought 863 tons, and that's the highest on record, by the way. Indian investors jumped in the action too. Gold ETFs saw inflows of 801 tons globally. Bar and coin purchases hit a 12-year high. Heading into 2026, the rally was already red hot. Everyone was positioned for gold to keep climbing. And then, last week happened. On Feb 2nd, gold fell approximately 20 to 26% because, folks, 3 events collided within 72 hours. Each one hit the market differently, but together, they created the most violent price swings gold has ever seen since 2008. Reason number 1, CME changed the rules in the middle of the game. CME Groups is the world's largest commodities exchange. It's where most gold and silver futures are traded globally. And last Friday, after seeing extreme price swings, CME decided to raise margin requirements. To help you understand this better, imagine you're in a crowded room and someone yells, "Fire!" If the door is wide open, people leave calmly. But if the door shrinks to, let's say, half its size, everyone panics and rushes at once. Now, that's exactly what happened. Coming back to CME, if you trade futures, you don't pay the full price of gold upfront. You put down a small percentage called margin. For gold, that margin was around 6% of the contract value. For silver, it was about 11%. CME raised gold margins to 8% and silver margins to 15%. And these new rules kicked in from Monday's market close. So what did that do? When margins go up, traders who were heavily leveraged, meaning they borrowed a lot to take big positions, suddenly need to post more money. Now, if they can't, they're forced to sell their positions immediately. So that led to mass selling because traders were forced to exit positions to meet the new margin requirements and not because demand dropped. Now, that drained liquidity from the market at exactly the wrong time. Every price move after that got exaggerated. Every small dip became a big crash. Small bounces became sharp rallies. Now, reason number 2, Trump just changed the future of the US dollar. Last Friday, President Trump announced Kevin Warsh as his nominee for the next chair of the Federal Reserve. Now, why does that matter for gold? Because the Fed chair controls US interest rates, and US interest rates determine the value of the dollar. And since gold is priced globally in dollars, even small shifts in rate expectations move gold prices instantly. For months, markets had been betting Trump would pick someone who would push for lower interest rates because they weaken the dollar, which typically pushes gold higher. Now, that's been part of the rally story for the past year. But Kevin Warsh is the opposite of that. Warsh was on the Fed board during 2008 financial crisis. While everyone else was pushing for aggressive stimulus and easy money, Warsh argued for tighter policy. He's literally written papers with titles like The Threat of Fiscal Dominance. Now, he's known as a hawk, someone who favors high rates to control inflation even if it slows growth. Markets saw the announcement and immediately priced in higher rates. The dollar strengthened and gold fell 4% within hours. But gold didn't stay down, it crashed and then bounced back. Because while Wash's nomination signals tighter policy eventually, the Fed can't hike rates immediately. Rate cuts are still expected in 26, so traders are still stuck in this weird middle ground, pricing in both short-term easing and long-term tightening at the same time. Now that's creating these crazy moves. Gold falls on Wash news, then rallies on tariff cuts, then falls on strong job data, then rallies on geopolitical risk. Every headline moves the market violently because no one's sure which narrative wins. Now finally, the third reason, and this is why the rally did not break. While prices were swinging wildly, actual demand for physical gold stayed strong. Now, according to the World Gold Council, central banks bought 863 tons of gold in 2025 alone. Now, that's close to record levels. Countries like China, India, Poland, and Turkey kept accumulating gold reserves throughout the year because central banks don't care about weekly price swings. They're buying gold as a long-term hedge against currency risk, geopolitical uncertainty, and inflation. They see the next 5 to 10 years and not next 5 to 10 days. And it wasn't just central banks, by the way. Indian households who love gold bought them in bars and coins at levels not seen in 12 years. Gold ETFs globally pulled in 801 tons of inflows in 2025. So every time gold dipped last week, buyers stepped in. Central banks, institutional investors, and even retail buyers in India saw the crash as a buying opportunity, and that's why gold bounced back so fast. The floor kept rising even as volatility spiked. Prices swung violently, but they didn't collapse. They found support almost immediately every time they fell. Now, this is what makes the current environment different from past corrections. Usually when gold crashes 26%, it takes weeks or months to recover. But this time, it recovered in days because the underlying demand never left. Now, alright, now that you know the three reasons, CME margin hikes, Kevin Wash nomination, and record demand, now let's talk about what this actually means for you if you're holding gold or thinking about buying. Now, if you're already holding gold, first don't panic because of the volatility. This isn't like 2013 when gold crashed and stayed down for years. Central banks, as I mentioned, are still buying. Geopolitical risks haven't gone away. Global debt levels are at record highs. Inflation expectations are sticky. Now, these are all reasons why institutional investors still see gold as a long-term hold. As I mentioned, JP Morgan's forecast of $6,300 per ounce by the end of 2026 hasn't changed despite last week's crash. So, if you bought gold as a long-term hedge, say 5 to 10% of your portfolio for diversification purpose, this volatility is just noise. Experts say hold. Now, if you're thinking about buying gold, understand what you're walking into. Short-term volatility is going to continue. We're in a period where every Fed announcement, every tariff headline, every geopolitical flare-up will move gold prices sharply. See, some days it'll swing 3 to 4% in either direction. So, if you're buying gold for the long term as a part of diversified portfolio again, then this volatility actually gives you better entry points. But if you're buying gold because you think it will go up 10% next week, then this is a wrong market for that. Short-term trading in gold right now is expensive and risky. Third, if you're holding gold through ETFs, understand that ETF prices will mirror spot gold volatility. ETFs are still one of the cleanest ways to hold gold exposure without dealing with physical storage, purity issues, or making charges. Just make sure that you're not over-leveraged in gold. A good rule of thumb is 5 to 10% of your portfolio in gold is diversification. 30-40% is speculation. Know which one you're doing. So, folks, here's where we land. Gold crashed 26% in 3 days, then bounced right back because three forces hit the market at once. JP Morgan still expects $6,300 by year-end. Central banks are still buying. The rally isn't broken, it's just adjusting. There could be more short-term volatility, but the long-term outlook still looks intact. So, if you're holding gold as a hedge, stay calm. If you're buying, understand the environment. And if you're trading, be careful. This market is moving fast and the rules just changed.